right. Welcome back, everybody. Today is Wednesday, November 20th, 2024. This is You've Got Options for Income Navigator. And today we are going to talk about choosing expiration cycles for maximum profit potential and how to optimize your option selling strategy. So, the first thing we are going to talk about is why expiration cycles matter. And the reason why they matter is because expiration cycles, and we have nowadays many different expiration cycles, especially in the index options, right? If we're looking at ES or SPY or SPX, we have not just weekly, we have daily expirations. So you can go from one DTE all the way out to 30, 45, 60, 90, and all the way out to leaps. But different expiration cycles, they impact, number one, time decay, which is one of the most important components, also known as theta. They also impact your risks exposure, how long you are exposed to market risk. And they also impact your profit potential. Now, we know that we can choose anything from 0 DT, which probably be the shortest expiration cycle, all the way out to leaps, anything beyond 365 DTE. Now, the reason why we are going to talk about shorter cycles is because you get faster capital turnover, and that's the good part, right? That's the benefit. But on the flip side of that coin, the shorter the cycle, the more risks you're potentially taking on. So there's a trade-off there. Now, the right expiration cycle will optimize your income and minimize your risk. There is a sweet spot, so to speak, right? You have to understand, number one, your own risk profile, right? How active do you want to be? Do you want to look at your positions 3 times a day? Do you want to stare at your computer all day long and worry about every single tick? Or do you want to put something on where you can just check in once a day and go on about your business? So knowing your risk profile will help you find your window or that sweet spot where you want to trade if you are a net option seller. So let's talk about the one of the most important components, which is the theta decay. We all know options will lose value over time. This is known as option decay or decay of the time premium. We also know that decay accelerates significantly in the last 30 days. Now, we all saw this graph, right, that goes, it shows you DTE from 90 all the way down to 0, and from 90 or 120 DTE, the rate of decay is very, very slow, and then it starts to accelerate when we get to about 60, and then at 45, 30, and then it becomes extremely, extremely fast in the last 7 days. That is true for at the money options. When we're dealing with far, far out of the money options, that curve is actually a little bit different. We are not going to dive into that today, but we need to understand that there is still a significant rate of decay in out of the money options in the last 30 days. Now, this is my opinion. Selling options in 30 to 45 DTE window captures the best or the most theta decay. There has been a lot of different back tests. Our friends over at Tasty Trade, they've done a number of different studies from every different angle, and they are saying that the most beneficial decay is somewhere in the window between 56 DTE down to 45 DTE. Now, I think 30 DTE still works, and I'll show you why. But the window between 30 DTE to 45 DTE, I think works best for me, right? If you don't want to be exposed for too long, if you also have a trade plan that you're trying to put in place, for me, 30 to 45 DTE works best. And we'll talk about how I use option selling for my trades in just a little bit. So a quick example, right? If we look at SPX 10 delta puts, they will lose about 75% of their value in the 15 days, right? So we start at about 30 DTE, and I'll show you this in just a second. So here you see we look at SPX puts with 30 days to go. This is a 10 delta put that's valued at about $15.80. And then we can assume, right, everything else being equal, right, that volatility isn't going to explode or there isn't a massive move to the downside, right? We could assume that when this same 55.25 put has only 15 days, which is half of where we started, the value of this put is now $4.10. This put will essentially lose about 75% of its value in 50% of the time, or 50% of the duration. Does it always work that way? No. But most of the time, when markets are calm, when volatility is somewhat in check, we could expect to see a big drop in the premium in the first 15 days. So why is a 30 to 45 DTE a sweet spot for me? Number one, and we talked about this in not in the previous meetings, but a couple of meetings ago, for adjustments, right? So time for adjustments, if the trade moves against me, is still available. If we sold a put with one DTE, you don't have the time to be right. You don't have the time to make the adjustment. Things start to move really, really fast, and you need to be right away. Otherwise, your trade can get in trouble really, really fast. 30 to 45 DTE for me also has a balance between risk and reward. I want to avoid high gamma risk that we often see in the shorter cycles, where if you sell a 1 DTE put, because there's not a lot of time, so you're not selling a lot of time premium, you have to trade very close to at the money. And if you get a 2 standard deviation move against you the following day, right, your out of the money put is now in the money. And as we talked about this before, making adjustments on short puts that go deep in the money becomes very challenging. And that's what I want to avoid. Right. So I think that 30 to 45 DTE provides a decent balance between risk and reward, and also allows me to avoid that high gamma risk. Now, 30 to 45 DTE also enables capital recycling by closing trades early at profit targets, meaning that if I sold a put at 30 DTE and say in the first 2 weeks, right, 15 days go by, if I could capture 75% of max potential profit, I can close this trade out and set up another 30 DTE short put, again, looking for something similar to what I just did. So I'm not going to stick around for the remaining 50% of the DTE or 50% of the duration to capture the last 25% of that premium. To me, it isn't worth it. Now, if you do the math, right, if you can capture 75% of max potential profit in just 15 days versus holding until expiration to make the 100% of max potential profit, you'll do much better by closing out early and capturing 75% of max potential profit. You will turn the same buying power, right, with a little bit more velocity. You'll get a little more frequency in the trade. And in the end, you will make more dollars. And also, staying in the trade for the last 15 days will remove some of that high gamma risk that we just talked about. Right. So, again, I want everybody to kind of think about this not as a solution to all problems. This is not, this works and everything else doesn't. This is just how I think about this. This is what works for me. And I hope that you are able to take something away from this. Um, I also want to point out, you know, there are a number of questions that I get about, why aren't we using shorter DTE cycles? Why aren't we using longer DTE cycles? And as I said earlier, shorter DTE cycles, anything less than 10 days until expiration, there's always this two sides of that coin, right? You're getting something, but it's costing you something in at the same time, right? There's a trade-off. So with a shorter duration, less than 10 days until expiration, you get much faster theta decay, which is great, but you also have a lot more gamma risk, meaning that a one big move against you, right, can put your options deep in the money. And we know that once options become, at the money or they go in the money, adjustments become very costly. And sometimes you can't make any adjustments without significantly increasing your risk and or possibly paying a debit where you put yourself in the position where in the best case scenario, you'll end up maybe at a break even, or maybe you'll just eat a smaller loss, which is not ideal. Now, I know I have gotten some questions when we talked about the 1-1x bear trap. Instead of using a 30 DTE on the front month or the naked put portion of that trade, going with something like a 60 or a 90 DTE, right? Because we get safer position, right? We have more time, so we have more time to be right. Naked puts, for example, on the 60 DTE are a lot more forgiving than naked puts on a 30 DTE. Yes, 60 DTE naked puts are much safer, and you're probably getting a lower buying power requirement from a broker, but you're also getting a much slower theta decay, which means that you will have to stay in the trade for longer, right, in order to capture the same dollar amount. So and staying in the trade longer means that you're going to be exposed to markets risks for longer periods of time, right? If I initiate a trade with 30 DT and I'm out of that trade in, let's say, 15 or 18 or 20 days with 75% of that premium, if I initiated that trade with 60 DT, I may have to stay in that trade for 30 days to make the same dollar amount, right? So staying longer, which exposes you to market risks for longer. In my opinion, 30 to 45 DTE on the front month. And I'll explain what front month is for those that aren't familiar, but 30 to 45 DTE strikes a balance between time decay and risk exposure. 30 DTE is only about, 4 weeks. It's not a long time. So while we don't have to wait for a long time, we don't get as much risk exposure. And if things do go wrong, especially early on, we have the time to possibly look for moves. And we'll talk about what those moves are. Let's touch on managing trades within that 30 to 45 DTE range. Um, 50 to 75% profit is just a guideline. You can wait longer. You can get out at 50% and recycle. I mean, I think 50% could come much faster than 15 days if we use the same example that I just showed, where we initiate a trade at 30 DTE, and by 15 DTE, that option will lose 75% of its profit. But as a guideline, 50 to 75%, I think, is reasonable. Adjustments. We covered adjustments before. We have several things we can do. We can possibly roll out, up and down, right? So where we buy to close the option we are short and look to reestablish a position. Again, this is not some secret sauce. Rolling out is the same exact thing as buying to close a bad trade and selling to open a new trade. You want to look for an improvement. You want to get a better price. You want to collect the credit on that roll. You want to do something that is eventually going to get you out of that position. And while you're doing it, you're extending your duration. You want to get some benefit for it. So on the rollout, I look to extend my duration by maybe a couple of weeks, 10 days, maybe 14 days, and push my strikes down if it's a put or up if it's a call, and collect the credit on that transaction. You could also look to convert to spreads. If you short a put and the market's starting to move against you, instead of rolling right away, you may buy another put at a lower strike price, making this naked put into a spread. You will be spending some of that credit that you had collected for the naked put. This will remove that exponential risk to the downside at the expense of lowering your max potential profit, right? This could be a temporary fix, right? You convert into a spread, market finds some sort of a balance, and then you look to uh, convert spread back into naked options. It's probably going to be a debit, so it isn't my favorite thing to do, but at the time of high stress, this is one of those things that you can look to do. Converting into spreads will also take care of some potential margin issues and so on. We'll talk about that in another time. And you can also use a hedge, right? You can use long options and different expiration cycles. This is a little bit more complex. You want to understand what your directional exposure is with your naked puts or naked calls, and just try to neutralize your position by using options at a different expiration cycle. And then again, this isn't a kind of a set and forget type of an adjustment. You want to, um, if you are using a delta hedge and you're spending some or all of the initial credit that you had collected, you also want to unhedge as soon as the conditions have improved. And again, this is slightly more advanced. You want to understand what you're doing. And you definitely don't want to overreact, right? Hedge, unhedge, hedge, and hedge every other day, because you will just chop yourself up into a million pieces. Definitely want to monitor your positions daily and avoid overreacting to small moves, right? If the market is going against you, you thing that, all right, I need to bring in a hedge. You buy something, you're paying for it, right? And you're paying for it while the market's moving higher. Odds are you're maybe slightly overpaying for that hedge or insurance. And then the next day market is going to bounce and you unhedge your position. And the following day market goes down again. Once again, you're forced to hedge, again, overpay for that insurance. Before you know it, 5 days later, you made a bunch of trades and now your naked put has no more credit. Best case, if everything else works in your favor, you end up with a break even trade. And that is just because you are overreacting. A good example of this, something like we saw yesterday, right? Market started lower. If you were concerned, you bought hedges. By the end of the day, market bounced quite a bit. You might have closed your hedges. And then this morning, the market is down again. Are you going to go back and buy that hedge? Or maybe you should have left it open, right? So these are the things that you need to think about when you think about different ways to manage your short puts or calls, whatever your options are. Now let's talk about how I use this 30 to 45 DTE window in my trading, right? As you know, one of the core strategies that I use is a 1-1x bear trap, where I am short naked puts. That is my income part of my strategy. And then I buy put debit spreads with more time until expiration. So my naked puts, that's my front month, right? If we're talking about um, in expiration terms, right? I have a 30 to 45 DTE, that's where my naked puts are. And then I have 150 or 180 DTE, that's where my put debit spreads are, right? So I sell inside of that window, the reason I use 30 to 45 DTE is because if I say 30 DTE, sometimes it isn't available. Maybe volatility on a 35 DTE is higher than 30 DTE, and that's more attractive to me. I don't want to make it, only do 30 or only do 35. It's somewhere within that window. Everyone should kind of think for themselves and understand what works best for each and every one of us. And inside of that window, that is where my naked puts are. That's my income generating part of my strategy. I sell naked puts in that window to generate income and to pay for the longer dated put debit spreads in my strategy, right? So if I'm long put debit spreads 150 DTE, my front month naked puts are going to cover the cost of those put debit spreads and generate income because I am selling 2 naked puts for every 1 put debit spread on the back month. I take advantage of the rapid decay to generate income. And also, this allows me to build up a put debit spread wall, so to speak, right? And assuming that the front month pays off the cost of the put debit spreads, if I sell a 30 DTE naked put and I buy a 150 DTE put debit spread, I can sell about 5 30-day naked puts in that by the time the 150 DTE put debit spread comes to expiration. Right? So I am able to use this smaller window for the naked puts to generate multiple tranches of those put debit spreads, and those put debit spreads will be financed by the short naked puts in that 30 to 45 DTE window. I hope that is clear. If it isn't, we'll talk about the details of the 1-1x bear trap that I use and different ways that we can modify this trade to make it maybe a little bit more efficient. I also like this 30 to 45 DTE because it has enough time for me to make adjustments in case the underlying moves against me. We talked about this before, but what I look for in my front month options, if I sell a put maybe at 8, 9, 10 delta, if it doubles, if it gets into the high teens, maybe up to 20, to me, that is the time when I need to make a move. I don't want to wait for my naked short puts go to delta 50, right, at the money, because one more down day, now I'm in the money. And again, I repeat myself time and time again that if you let your options go deep in the money, the deeper in the money they go, the more challenging it will become to make any kind of adjustments without taking on additional risk and or paying a debit, which will significantly reduce your profit potential. So I feel like 30 to 45 DTE is kind of like that sweet spot for me where I'm able to take advantage of rapid uh, premium decay and also gives me the time to make moves if the underlying is going against me. Kind of what we are seeing right now, but not really because the last tranche of 1-1x bear trap I put on last week, I believe was on Friday. Market's down a little bit. I mean, I just look at the short delta, the naked put delta, and if it's not in the high teens, yeah, it sucks. The trade may be at a drawdown, but it's just part of the business. There really isn't a need to overreact because I know that my adjustment point is when my short strike delta gets into the high teens, maybe it doubles and gets to in the range of about 20 delta. And my goal is going to be rolled down and out an additional 10, maybe 14 days, maybe 18 days. I don't want to roll too far out in time because I know that once the market stops going down and maybe volatility will come in, I want to participate in that volatility crush. If I roll my options out 120 days, when the market eventually will reverse and volatility will mean revert, those 120 DTE that I rolled out to, they're not going to feel a lot of that volatility crush. most of the volatility crush is going to happen on the shorter end of that term structure, or on the shorter end of the curve, if we are looking at different expiration cycles. And adjustments are rolling up and down, right? Up if it's a short call, down if it's a short put, and out in time plus 10 plus 14 plus maybe 18 days. And I want to get a credit for my roll. If I'm going to extend my duration by an additional 2 weeks, I need to collect the credit. Otherwise, if I roll it up or down and out for a debit, it's kind of a lose-lose situation, meaning that I extend my duration by extra 2 weeks, so I expose myself for 2 more weeks of markets risks, but I also have to pay for it. So I have to pay to participate for longer. Doesn't make any sense to me. Now, there are situations where, I have to pay a debit in order to improve my position. If I'm a little late to making adjustments, or for whatever the case is, maybe the move is, a lot more aggressive than I initially anticipated, and now I am slightly behind on my adjustments. If I have to pay a debit, I have the put debit spread wall that should be profitable, right? Because it has more time until expiration. And I'm going to look to capture the extrinsic value of those put debit spreads. That's why I have them for, to help me pay for any adjustments if necessary. Right. So that kind of brings it all together. If I have to roll down and out and it's a debit transaction, I will sell some or whatever I have to sell on that put debit spread side of this strategy to cover any of the debits that I have to pay in order to roll my naked puts down and out. Lastly, we'll talk about the takeaways from what we talked about today. So again, 30 to 45 DTE is ideal for me for balance of risk and reward. You have to set a clear profit target ranges for your trades. Don't look for someone to tell you when to take a profit. If you have to come in and ask, guys, I'm here and there, what would you do? It's probably best that you close out the trade. Follow your plan. No one is more invested in your business than you are. And one of the most important things, in my opinion, is to use index options. I know we use a lot of options on futures. You want to find the most liquid options, because that will provide you with an opportunity to make adjustments, to get in and out, right? To open, to close. Liquidity is a major, major risk. And we know that, we have these micro contracts in oil, MCL, and E-mini S&P 500, MES. At times of high stress and very fast market movements, these two, MCL and MES, and I'm not here to, make them the bad guys, but we have seen that these become the most illiquid. If you need to make an adjustment, you just don't have the other side of the market, because again, if you are trading futures and you want liquidity, you want to trade where the institutional traders are, and they're definitely not in the micros. Micros is probably 100% retail, and you don't want retail to be on the other side of your trades, because they won't be there when you need them. So these are some of the takeaways from today's presentation. This is what I use in my trading. I hope this is clear. I'm pretty sure that there are some questions, and we are going to take a few minutes. If you guys have any questions, you can post them in the chat box here. I'll try to answer a few, and then I will let you go on your way.